had a chance to catch up on the video from last week. The reason being that in our session today, we're going to be a little bit faster because we explained quite a number of the concepts from our class last week. We spent quite some very good time explaining the concepts of international investment appraisal. And so for that, we didn't go that far with the question last week in our previous class. I want to believe that we've had a chance to review that right before this class, because it's going to be super helpful for this class. And if you've not, please just go in and look for the part A of this of the video on international investment appraisal and and quickly catch up. Okay. So with that said, let's get right to our plan for today, which is to complete a consideration of international investment appraisal. All right. So in our previous class, we introduced a concept and then we commenced our solution to question 1, November 2020 past question. So we looked at the computation of the company's performance at the subsidiary level. And then we also moved to the repatriation of the fund from the foreign subsidiary to the home country. We stopped at the point where we're computing taxation, and we explained the concept on taxation as it relates to international investment appraisal. So where did we explain that concept? We explained it somewhere. Where did we explain that concept? Maybe up, right? Okay, yeah. So I think we had a concept before we moved right into the quiz. So yeah, it's right here. So we explained the concept on international investment appraisal right before we moved on to, and that's what we stopped really at our previous class. And then now we're moving on to our computation on taxation. But just before I get into the class for today, I wanted to take a moment to see if there are any questions from our class last week. So when I say any questions, it will be on any of the concepts, on any of the computation for those that watched the video ahead of the class or that were in the class. Do you have any question on any of the concepts we discussed last week? Or so I can just quickly take questions on that before we get right into our plan for today. Sophia, please go ahead.
Yes, sir. Good afternoon, sir.
Yeah, good day.
The challenge I'm having is how to convert this the conversion rate. That's my problem. I'm finding it difficult to understand.
Okay, so what isn't how to convert from one currency to another? Is that what you mean?
Yes, currency conversion.
Okay, so I gave you guys the format or an approach or a strategy to use. Now, if you use that strategy, you would never get it wrong, especially if you are still learning the ropes. In other words, if it's not something you've done before, you need a strategy or an approach to use for that purpose. So I gave you guys a strategy to use. So I think I would recommend that you stick to that strategy. Out of the strategy, one is the first thing you need to do is to determine which is the variable and which is the base. That's the first thing. So once you skip that step, you're going to, especially if it's not something you're used to or you're doing, you're going to struggle to do that or to complete the conversion. So the first thing is actually what is the variable and what is the base. Once you determine what the variable is and what the base is, the next step we to ask yourself, what are you converting? Are you converting the variable or are you converting the base? So once you know what you're converting, once you know what the variable and the base is, that is the most important step. Once you know maybe a variable is Naira, I'm converting from dollars, so I'm converting from the base. So once you know what you're converting from, just apply the rule I gave you guys. apply the rule I gave you guys, which is pretty straightforward. If you are converting from the base, we multiply. If you are converting from the variable, you divide. Okay. So I think I will encourage you to have a watch at that session of that part of the video again. And if you still have a challenge, please reach out to me or drop a message in the group and we'll attend to that. Okay? But just try and follow the steps. Just start by my advice is follow the steps we discussed in class. Okay?
Okay.
All right. Okay, so let's get right back to the no further questions or comments. So let's get right back to where we stopped in our previous from our previous class. So let's get right back to it. So we explained the concept of taxation, and so in our case, the question does not mention whether or not there's bilateral trade agreement. Unfortunately for us, there is zero tax. There is zero tax in what's the home country's name again? Sorry, I need to remind myself of the country name, the name in the question. Linda. So fortunate for us, there's no tax in Linda. So we didn't charge any tax in Linda. And so that therefore means that the only tax we would charge would then be the tax in Nigeria. So what's our tax rate so that we can go ahead with that quickly? And when is the tax payable? So whenever you're dealing with tax, you need to ask yourself, what is the tax rate and when is the tax payable? Is the tax payable in the year that you generate the profit, or is payable in advance, or whatever the requirement is? So let's get right to our tax. So let's scan through where do we have our tax in our question. Okay, it says right here that corporate income tax is charged in Nigeria at 35% on taxable profit and is paid at the end of the year in which the taxable profit arises. In other words, if we do make a profit in year 2020, whatever tax is due for that year is payable in that year. And the rate is 35%. So let's go right into our computation of the tax at 35%. So we're going to do that right away. All right. So our tax is 35%. Okay, so let's get right into it. So in our first year, we have a profit of 25.53. So considering our tax, what do we have? Okay, just a moment. So 23.53 multiplied by 0.35. Our tax is 35%. That gives us 8.24 as our tax. Okay, the following year, 54.69 multiplied by our tax rate of 0.35 gives us 19.14. Following year, 55.87 multiplied by 0.35 gives us 19.55. Finally, 57.06 multiplied by 0.35 gives us 19.97. 19.97. Okay, so Hope you guys are computing with me, just in case I point you wrong figure anywhere, but that's are the values that we have. All right, so we've done our taxation. Now, one of the things that, because of the approach we use, one of the things you would do at this point would be to go back to your question and see if there are any tax allowable depreciation, so that we can compute what the tax savings are. So if there are any tax allowable depreciation or capital allowance at this point, or if there are any loss carried forward. However, in our question, we don't have any loss. Our question, we don't have any loss. All of our years are profitable. So 23, 54, 55, 57, they are all profit. So we don't have any loss carried forward. So we're not treating loss carried forward. So the next one will be to check, do we have any tax allowable depreciation that we need to take into consideration the tax savings from that tax allowable depreciation. So that's the next step. So let's go right back to our question and see if we have any tax allowable depreciation that we should consider. So let's go right back to our question. We did invest in an equipment. So let's see if there's any tax allowable depreciation that arises from that. All right. So we have a point right here in bullet point 3 on other relevant information right here. So let's read it together, guys. It says, corporate income tax is charged in Nigeria at 35% on taxable profit and is paid at the end of the year in which the taxable profit arises. So we've handled that. No separate tax is charged in Linda. Tax depreciation allowances are available in Nigeria on all capital expenditure incurred both in Nigeria and in Linda at a rate of 100%. So in other words, your first year of production is giving you 100% capital allowance on whatever you spend on your equipment. Balancing charge will arise on any residual value. So they are giving you 100% allowance in the first year at the rate of 100%. And then whenever you sell the equipment, you will incur balancing charge on the residual value. So all we're basically just doing is interpreting the information and translating it into our computation. So the question tells us two things: that in Nigeria, you're going to get a tax allowable depreciation of 100% on the equipment, basically implying the first year you get 100%, because it doesn't mention that you're splitting into different years. It also mentions that you will incur a balancing charge on any residual value. So when you sell the asset, you would incur a balancing charge on it. So let's look at what is our tax allowable depreciation, which is 100%, which will we incur immediately when we purchase the asset in the first year, and what will be our balancing charge. So we're using the tax savings approach. So we're going to use the tax savings approach for that. So let's get that right into it quickly. So let's get right into it quickly. So we would have, because we do have an equipment, we would have our tax savings on tax allowable depreciation. So TAD, I'm referring to tax allowable depreciation, guys. Then we're going to have our balancing charge, bracket, tax. So let's begin with the tax savings. So they're giving us 100% on the value of the asset. So how do we calculate our tax savings on capital allowance? It's pretty straightforward. The tax savings on tax allowable depreciation would be whatever your capital allowance value is. So your tax savings on capital allowance would be whatever your capital allowance value is, multiplied by the tax rate. That gives us the tax savings. Now, in our question, they mentioned that they are giving us 100% of what we bought the asset. So if we bought the asset 10 million, our capital allowance is 10 million. If we bought the asset 20 million, our capital allowance is 20 million, etc. Because they're giving us 100% right at year one. So what is our capital allowance in this question? It boils down to what is our investment, how much did we buy or invest in setting up. So we have that in our question. Okay, our question is up. Yeah, so we have that in our question. So we have our investment right here in our question as 84 million Liberian dollar. But we're in Nigeria, so we're interested in the value in Naira. We did explain our conversion last week, which would be we're converting from Linda to Naira, we just divide, which is what we did here. If you want to understand, if you want a refresher on that, please refer to our part A video, please. So we're converting these to Naira. So we just divide our 84 by the exchange rate. So under what year is our 84 and what's the exchange rate for that year? So our 84 is under 2019. The exchange rate for 2019 is 1. What do you call it? It's 1.24, 1.20 rather. Please just give me a moment. Please give me a moment. I need to pick my calculator. Okay, yeah. So I'm back with that. So our exchange rate at the year we bought the asset is 1.20. My calculator dropped, so I was trying to pick that. Okay, so what would that be in Naira, the Naira equivalent? So that would be your 84 divided by, that gives us the capital allowance, not the tax savings. We need to multiply it by the tax rate to get the tax savings. So 84 multiplied by 1.20 would give us the value in Naira. So whatever the value in Naira is, we multiply by the tax rate, which is 0.35 or 35%. Okay. So what's the value? What's the tax savings? It's savings for us. So it's a positive value. So 84 divided by 1.20 gives us 70, multiplied by 0.35 gives us 24.5 as our tax savings on tax allowable depreciation. So that's 24.50. So that's our tax savings. Now, if we do have a residual value, or we dispose of the asset, we would pay tax, which is the balancing charge. The question specifically mentions that. So let's see if we're going to sell the asset for any value, and if we do, how much do we owe the government in tax? Whatever income we make multiplied by the tax rate gives us the value the government is going to charge us on tax. So do we expect to sell the asset? Yes. Mentions here in bullet point 2, right here, mentions that the proposed new distribution center to be built by Linda is expected to have a residual value of 52 million Liberian dollar after 4 years. So we need to pay attention to two things. We need to pay attention to what currency is that. It's Linda. We're computing our values in Nigeria, meaning that we need to convert the 52 Liberian dollar into Naira. When is it happening? At the end of the project, which is year 4. So after the end of the project, which is year 4, we're going to sell the project. And so we're going to make use of the exchange rate at the end of year 4. And that's what we're going to use for converting from the 52 to Naira, just like we used the exchange rate for 2019 to convert the investment, because that was where the investment occurred. So what's our exchange rate for year 4? I'm sorry, I should be going, where's my solution? Is it up or down? Okay, it's there around here. Yeah. All right. So right in year 4, we're going to have a scrap value of 54 Lindarian dollar. We need it in Naira, so we convert it to Naira. So what is our exchange rate for that year? So we go right back to where we did our computation last year. And, sorry, the exchange rate for the year, that is 1.2989. So 54 divided by 1.2989 multiplied by the tax rate. What are you interested in? The tax value, or the charge on that?
I think it's 52, sir. Is it 54? It should be 52.
Is it 50? Is it 54, 52? I can't remember. What did you read now? Okay, it's 52. We have it right here. We have it right here when this, so that's 52. Okay, sorry, I have to squeeze that into that little space, so it might not be too legible for you guys to see, but I believe you know what I'm doing. So I'm squeezing that into that little space. So it is 52 divided by the exchange rate, which is 1.2989. We then multiply it by the tax rate of 0.35. So 52 divided by 1.2989 gives us 40.03, whatever it is, multiplied by 0.35. So that gives us a value of 14.01. So you could just double check at your end as well, just to be sure that you're following along as we're doing this. So that gives us 14.01. So let's note that here. But that's the tax. We're making money, so we're paying tax. 14.01. Okay. Let me check if there are any hands, any questions. Okay, so we're good with that. So don't forget, in our previous class, and that's why I keep mentioning that you need to watch the video, we said that we're splitting our values into the profit side, which is part A, so that we can compute tax, and then we'll move in the investment. So now that we're done with everything that's to do with the profit side, let's now move in our investment, which is our part B, which is we're done with our part A, which is the profit and loss side, or the income statement side. Let's do our part B, which is to move down the investment values from Linda down to Nigeria. So our investment is 84 Lindarian dollar, and that happened in 2019. Our scrap value, not the tax this time, but the actual income we're receiving on our on the disposal is 52. So we're converting those to Lindarian dollar. 84, sorry, to Naira rather, 54, 84, and 52 is our investment. We're converting it to Naira by dividing, just like we explained in our previous session. So that would be 2019. So this would be 84 divided by the exchange rate, and I think I remember that as 1.2. This would be 52 divided by the exchange rate, which is clearly here, 1.2989. Okay. So our investment is an outflow. Is an outflow from us. So that is 70. What do you call it? Yeah, that's 70. So we need to compute the rest quickly. So what do we have here? What do we have here? What do we have here? And what do we have here? Oh, sorry, we've not brought in the investment part for the last one. So our scrap value investment, 52 divided by 1.2989 is 40.03. So let me double check that. Yeah, 40.03. Okay. Rather than inflow, because we're selling the assets. So let's now determine what our net value is then. Our net cash flow is then. So this is 70, which is a negative value. So what do we have here? What do we have here? What do we have here? And what do we have here? So this one is pretty straightforward. Okay, no, I need to subtract that. Okay, so let's begin with the first one. 23.53 minus 8.24 plus 24.50. 23.53 minus 8.24 plus 24.50. We have 39.79. Okay, next one, 54.69 minus 19.14. We have 35.55. Next one, 55.87 minus 19.55. We have 36.32. And the next one, 57.06 plus, sorry, I thought a plus, that's a negative. We didn't put our bracket. That's tax, so we didn't add our bracket to that. So 56.06 minus 19.97 plus, not a plus. What's wrong with us? We're paying tax. I'm putting it in positive. So we didn't put our bracket. Okay. So minus again 14.01. And then finally plus our disposal of the scrap value 40.03. That gives us 63.41. Okay, so there we are. So let's bring in our discount factor. We're done with everything. So let's discount and go get what our NPV is. Okay, so what's our discount rate in our question? Okay, so the question tells us that Oyin Division, that's the bullet point one. Bullet point one tells us that Oyin Division evaluates projects of this nature at a risk-adjusted rate of 15% over 4-year period. So a discount rate is given to us and it's risk adjusted, so we don't need to do anything. It's already given to us the risk adjusted value. And the rate is 15%. So a discount factor then would be 15%. So let's get that right in, a discount factor at 15%. Okay, so don't forget the computation of discount factor, 1 divided by 1 plus the rate raised to the power of n. So 2019 is year 0, 2020 is year 1, year 2, year 3, and year 4. Anything raised to the power of 0 is 1. So we have this as 1. So the next one, 1 divided by 1 plus the rate, which is 0.15, raised to the power of 1, gives us 0.870. 1 divided by 1 plus 0.15 raised to the power of 2 gives us 0.756. 1 divided by 1 plus 0.15 raised to the power of 3, which is here 3, gives us 0.658. So someone can double check that with me. And then finally, 1 divided by 1 plus 0.15 raised to the power of 4 gives us 0.572. Okay, so what's our present value? We're multiplying. 70 multiplied by 1 is 70. 39.79 multiplied by 0.870 gives us 34.62. $35.55 multiplied by 0.756 gives us 16. 16 point. Sorry, my calculator just went off. 16.21. $16.21.
Sir, is that 35.55?
Yeah. So what do you have? Maybe my calculator give me wrong value.
26,
What do you have?
26.88.
Okay, because the calculator dropped and I need to pick it up. So let me reset it. Just a moment. Let me reset that, and then I can just recompute it again. Okay, just a moment. 35.55 multiplied by 0.756. 26.88. Thank you for that. I guess when the guy dropped, it misbehaved. When it dropped, it misbehaved. So okay, so 26.88. Okay, so the next one, 36.32 multiplied by 0.658, 23.99. 23.99. Someone could double check that with me, because sometimes when you punch the calculator, it could sometimes mess up. 63.41 multiplied by 0.572, 36.27. This must be okay. 36.27. Okay, so let's get what our NPV is then quickly. Okay, so what's our NPV? We're summing up. So I need to mute it. If you're not speaking with us, please mute yourself. So okay, so we need to sum that up. So minus 70, which is a negative value, plus 34.62 plus 26.88 plus 23.99 plus 36.27. Sorry, my calculator is messing up. It's not giving me, the value is giving me, it's completely off. It's completely off what it should be. Just a moment, I think I need to quickly get my phone as a calculator. It's giving me 500 and something, which shouldn't be. Okay. All right, so I'm using my phone now. So 36.27 plus 23.99 plus 26.88 plus 34.62 minus 70 So what do you guys have? I'm not sure what this calculator is giving me. My phone is thinking. What do you guys have, please? Well, check that out.
I have 51.76.
Yeah, that's what that 51 point. Yeah, that's because my calculator still give me my calculator give me 180 something. I'm even trying to use my phone. I don't know whether there's anything. What do you have?
51.76.
1.76.
Okay, 51.76. Okay, positive, right? Positive, right?
Yes.
Okay, 51.76 million. Okay, so let me add it one more time because I'm the one doing the computation, so I don't be computing wrong values for you guys. 36 minus 70 plus just a moment, just trying to quickly understand why it's giving me that my calculator is giving me completely different values. Okay. I might have to rely on you guys. So it's not something is wrong somewhere with my calculations, with my calculators. Okay, so 51.76. So that's our NPV for scenario A. Okay, guys, any question? Let me see if anything. Okay, someone says you got 51.66. Someone else says got for 51.66. Can we reconfirm which of the two is correct? 51.66, 51.76. Just need one more person to confirm which of them is correct. Someone dropped in the chat that they got 51.66. Who's confirming for us? Which is correct? But I can't confirm. My calculator that are messing up. Yeah, so hi Sophia, please go ahead.
Elisa.
Yes, please.
Okay. Is it only in that in this capital expenditure that this tax saving will affect?
Our tax savings is on depreciation. So we explained last week that you might have a tax allowable depreciation on your investment, more like capital allowance. So if you're granted or allowed to claim that allowance, then it would only be on the investment. Okay, just like capital allowance. Capital allowance is only on a fixed asset or fixed investment. Is that okay?
So it's 51.76.
76. Okay, thank you for confirming. I can't confirm at my end, so I would have to rely on you guys if my calculator is messing up. So I would appreciate if some people can, some people can be double checking for me when I'm computing. All right, so we're going to move on.
Well done, sir.
Yeah, thank you.
I
yes,
think
please.
that year 2021 is 2022 is 23.90, not 99. You can confirm again, sir. It's
Okay,
23.
so let me double check.
So the answer is 51.67.
Okay, so let me double check that year again.
Yes,
I just hope that my calculator cooperates with me this time because that's where
she's
correct,
she's correct.
23 point what? 99. Okay,
23.899. Yes.
Okay, it's still giving me 23.99. Okay, let me just see if I could. Sorry, I was going to use my phone, but it's not close by, so that's why I. Just a minute. 658. Okay, yeah. So 90. You guys said okay. So if we put 90 there, the answer changes a little bit to 51.67. You guys said, right? Is that correct? Okay. All right. So
Yes, sir.
all right. So any question on this computation? We're moving on to scenario B, and scenario B we're going to be a little bit faster because we've explained all of the concept. The approach and the steps are basically the same. The only thing that changes is the value, because they said we should compute it for scenario A and scenario B. So in our scenario B, basically almost the same thing. We have revenue, we have cost, we have cost. So the only difference will just be that the values are different. So is there any question on scenario A you guys want me to address before I move on to scenario B? Because I want to believe that we'll explain all of the concept when we discuss scenario A. Okay, so if none, let's get right to our scenario B then quickly. So most of the things are the same. Just the only changes will just be in the value. So let's go with our scenario B. You can fix it right here. Okay, so our scenario B. Okay, so the only difference would just be where the value changes. So I'm just copying the same header, 2019, 2020, 2021, 2022, and 2023. Just copying the exact same headers. 2019, 2020, 2021, 2022, and 2023. Just copying that. We're beginning with the foreign country, which is a Linderian dollar. Exact same thing. So our first item is sales or revenue. So whatever we choose to call it. Did they call it sales in the question, or they call it revenue, so that we can stick to the same term that they use in the question?
Sales revenue.
Okay, they call sales revenue, so we can use anyone then. So we can use anyone there. So we can still call it sales or sales revenue. If that's what we choose to call it. So our sales revenue. Okay, so for scenario B, what's our sales revenue? What's the inflation? Is the inflation rate the same? Is it different? So that we know whether we're still doing the exact same thing. Okay, so our sales revenue is 55 million Linderian dollar. All of the above are expected to grow by 5%. So meaning that including the scenario B is also expected to grow by 5%. Sometimes in the question you might have maybe scenario A is 5%, scenario B is 6%. Please make use of the one that is applicable. But in our question here, it says all of them grow at 5%. So that means including scenario B is going to be growing at 5%. So let's do that quickly, 55 and then 5% for all the others. So it starts at 55. So I'm going to be a little bit faster on scenario B, please, guys, because we have already explained all of the concept when we consider scenario A. Okay, so 2021 grows at 5%. So that would be 55 multiplied by 1.05. I'm going to rely on you guys confirming for me because I'm not too sure. I don't know what's wrong with my calculator today, why it's sometimes messing up. So I have 57.75. Someone can reconfirm that for me. 57.75 multiplied by 1.05. I have 60.64. 60.64 multiplied by 1.05. I have 63.67. Hope they're all correct. Yeah, all right. So that's our sales. The next item we have is just like we had in scenario, in scenario A is our cost. Basically the same thing as we're given. So we less our cost. Okay, so just like we had in scenario A, our cost has two elements. Our cost has the Linderian dollar element. Here it was 10, here is 10. So it's the exact same thing. So I'll just copy the group, what we have under 10. But it also have plus 15 million. In scenario A, it was plus 20 million. Every other thing is the same. No, that nothing is different again. Here is 10, here is 15, but here is 10 and 10. So let's go right into it then. So 10, 10, here is 10, 10, and then that is 15. You can call it working. Which of the workings are we wait to be stop in our working? Okay. So this was our working one. The exchange rate, we could have called it our working two, just in case we need to reference it. Okay, so let's call it our working three, which is our cost for scenario B. Okay, so there are two elements. So the 10 is about the same thing. We inflated it by 5%. So I'm just going to copy the same thing that we have here down because it's 10, 10. That doesn't change. So my Linderian dollar for 2020, 2021, 2022, and 2023. So we explained how to compute those values in our first class. So we don't need to do that again. So I'm just copying the values down. We're copying the values down, which are 10, 10.5, 11.03, and 11.58, guys. All right. So let's copy that down. 10, 10.5, 11.03. So that's 10, 10.5, 11.03, and what's the last one? 11.58. 11.58. Okay, so we're also now adding cost. Oh, please mute yourself. You're not speaking with us. Please mute yourself. You're not speaking with us, please. I need to mute whoever is speaking right now. Okay, so we have the cost, which is the naira to Linderian dollar element. So that is our naira to Linda. Okay, so first thing first, just like we did in our example one, we need to determine what the value is in naira, the inflated value is in naira, and then we then convert it to Linderian dollar. So let's first get the cost in naira first. So it is 15. In scenario A, it was 20. So that's where the difference is. In our scenario A right here, it was 20, but in scenario B, it is 15. Every other thing would then be the same. So 15 multiplied by 1.05 gives us what? So 15 multiplied by 1.05, what does it give us? 15 multiplied by 1.05.
15.7. 15.7.
Yeah, thank you. So that's 15.75 multiplied by 1.05. 16.54 multiplied by 1.05. 17.36. Okay, so let's get our exchange rate now. It's the exact same thing as scenario A. So if you're struggling with how we computed the exchange rate, please make reference to our first class because we need to make progress on that. So I'm just going to copy the exchange rate from up down. That's what I'm just going to do now. Just copy the exchange rate down. So the first one is 1.224. 1.224. Next one, 1.2485. 1.2485. The next one is 1.2734. 1.2734, and then the next one 1.2989. Okay, so this exchange rate are Lindarian dollar as a variable. So they are Lindarian dollar as a variable. And because we are converting from the base, which is Naira, to the Lindarian dollar, we multiply. So if you want to get that, please refer to our previous video, our previous class, right before this one on that. Okay, so let's get our conversion quickly. So 15 multiplied by 1.224. 15 multiplied by 1.224. 1.224. I have 18.36. Appreciate someone to double check that for me.
It's correct, sir.
It's correct.
Okay. 15.75 multiplied by 1.2485. We have 19.66. 16.54 multiplied by 1.2734. We have 21.06. And then finally 17.36 multiplied by 1.2989. We have 22.55. Okay, so let's add up the values quickly. So the first one would be 28.36, 10.5, 10.5 plus 19.66, 30.16. The next one, 11.03 plus 21.06, 32.09. And then the next one, 11.58 plus 22.55 gives us 34.13. Okay, I want to believe that the values are all correct since I didn't get anyone correct any of them. So I want to believe they are correct. So we're just going to move those values up to our computation up there. So we're bringing in our cost under scenario B. $28.36. $30.16. So basically the same step. Well, that's why I'm taking a little bit faster because we explained all of this concept in scenario A.
Sorry, sir. I have a question.
Please keep your hand up. I'll attend to you soon. Keep your hand up. I'll attend to you soon. So 34.13. Okay, so those are costs. I'm taking a little bit fast because we explain this concept in our first scenario A computation. Adetunji, please go ahead. The question. Adetunji, are you there?
Hello, sir.
Yes, please go ahead.
Please, the exchange rate. Can you print the exchange rates? This figure
Can I what?
The figure I just computed at least. Now I want to convert something. I want to confirm something on them.
Okay, so I should take it to the exchange rate, right?
Yes. Yes.
All right. Okay, so this is how we computed it last week. So you need to, get that. You can look at that.
Yes, I know. But this new one we computed, I want to see.
No, I didn't compute it. It's the same thing. I just copied it down. Because it's still the same. Just that there are two different scenarios. The exchange rate does not change. So I just copied down what we had.
Okay. This 18, sir. This 18. 18.36.
Sorry, I didn't get that.
This 18.36, sir.
Okay, yeah, yes, please. Yes.
Okay, it's got a 50.
Yes, please.
Okay, 15 times. I'm coming on 224.
0.224,
Okay,
yeah.
yes. I've gotten it.
All right then. All right.
Thank you, sir.
You're welcome. Okay, so we explain how we explain all of that in our scenario A. So we need to save time on that. Okay. All right, so that's our cost. So just the same thing as scenario A. What comes after cost? We have our profit before tax. So let's get what our profit before tax is. So our profit before tax, PBT. So 55 minus 28.36. I have 26.64.
26.64.
Yeah. 57.75 minus 30.16. I have
27.59.
27.59. Thank you. 27.59. 60.64 minus 32.09. We have 28.55. 63.67 minus 34.13. We have 29.54. So there's no taxation in Linda. So we just have that placeholder to show that there's no taxation. So there's nothing, there's no tax. The question tells us there's no tax, just like we have in scenario A, there's no tax. Okay. The next thing would then be our investment. It's the same thing for both. It doesn't change. So we just copy that down. What changed in the scenario B was just the revenue and the cost. The investment value, the question doesn't tell us that they're looking at a different value for scenario B. So we just copy that down, 84 and 52 as our investment. 2019. $84. And then right here, 52. Okay, so what next? Okay, just let's double check if there's any other thing that is specific to scenario B apart from the change in revenue. Just double checking that we've not missed anything. If there's anything that is specific to scenario B. So this is for everyone. This is for everyone. There's nothing specific to scenario B here. This is where we have scenario B as being different. This is the same thing. This is probability, expected value. We're going to come to that. So nothing here is specific to scenario B. Nothing here is specific to scenario B. So the only thing that changes is just the revenue and the cost. That's the only thing that changes. Every other thing is the same. So with that quick check, we can then compute our net cash flow then. Okay. All right. So we're right here. So let's compute our net cash flow. So this remains 84, which didn't change. This is 26.64. This is 27.59. This is 28.55. And then the last one, $29.54 plus 52. 29.54 plus 52, 81.54. So you can see that it's pretty straightforward once you know the concept, and it's faster. Unlike when we're explaining everything from the very start in scenario A, it took hours, but you could see that we're already at this point with that in our scenario B. All right. So with that said, let's bring in our remittance. Now let's bring in our exchange rate and then we can then remit. So let's just copy our exchange rate down, 1.20 on the right. So let's copy it down. As it is up, our exchange rate. So we're just putting down our exchange rate just like we had in scenario A, nothing. Okay, just a minute, what's this not showing? Okay, so we're bringing in our exchange rate, 1.20. So we have on a 2019. The year after that, 1.224. I'm just copying the exchange rate from up down. Nothing changes. 1.224. After that, 1.2489. 1.2489. One after that, 1.2734. 1.2734. 1.2734. Then finally, the final year, 1.2989. So we're moving that up. Please let me mute yourself. If you're not speaking with us, please let me mute yourself, please. 1.2989, the final year exchange rate. 1.2989. Okay, so that's our exchange rate. These are Liberian dollar as the variable. Okay, so with that done, we need to convert. So we're going to do just like we did in a previous session. We're going to do it in twofold. We're going to first look at the profit part so that we can compute tax, so that's required. Once we are done with the income statement part, we would then be able to move the investment part, which is the final part. So that's what we're going to do. So let's begin with the first part. Sorry, someone says to me, can you take your hand up so that I know if you want to speak, if you want to ask a question or something? Okay, there's no hand. All right, so we're beginning with the profit part so that we can compute tax, just like we did in scenario A. And then once we're done with the profit part, we can then bring in the investment part, which is the next part. Okay, so I have, if anyone, your hand is up, please go ahead.
Yeah, the figure you copied for 2021 for exchange rate is 1.2485, not 9.
Okay, so let's double check that. 1.2489. What do I have up? 1.2485. Thank you. Okay, let's get down with our remittance. So just like we mentioned in our previous class, if there is any restriction, just like we explained, just ensure that you move only the amount that you're permitted to move. But in our scenario, there's no restriction. So we assume that we're able to move in, 100% whatever we made from Linda. Very important to take note of that. Okay, so let's remit. So we're remitting to Nigeria. So profit 24.64, converting it to Naira to be 26.64 divided by 1.224. So what do we have as that? 26.64 divided by 1.224. So by my calculator, I have a profit I'm remitting of 21.76. Hope that's correct. If it's not correct, someone could double check that with me. Next one, 27.59 divided by 1.2485. Just a moment.
22.0985.
Divided by 1.2,
22.10.
1.2485. Okay, 22.10.
Is there
22.10.
okay? Yeah, okay, yes.
22.10. And then the next one, 28.55 divided by 1.2734.
22.420.
22.42. We're keeping it to 2 decimal place. And then the next one, where you're concerned about the profits part right now first, 29.54 divided by 1.2989. So 29.54 divided by 22.74. So 22.74. Okay. All right. So that's this. Those are the values. So those are the things that are basically related to scenario B. So let's move in. Let's move in every other thing that's for scenario that is for everybody. So let's move in everything that's for everybody. So what is for everybody? We have additional expense of 30. That doesn't change. So I'm bringing that in. Additional expense of 30. Additional expense of 30. Then another thing from scenario A, sorry, for everybody, which we already saw scenario A, that we needed to, okay, I think that was the only thing. So we have our profit before tax. So we have our profit before tax. So let's, okay, so let's get that out. 21.76 minus 30 gives us minus 8.24. Someone can reconfirm that with me. Okay, now let's go to our taxation, and then I'm going to explain principles on taxation quickly. I've explained it before, but I'm going to explain the principle around laws quickly before we move forward. Now, if it's financial accounting, we generally assume that, oh, it's a loss, so you're not paying tax, and we move forward if it's financial accounting. However, if it's strategic financial management, we tend to look at the implication of the loss on us as a business, rather than just the financial accounting rule, which is that if you make a loss, there is no, what do you call it? There's no tax. That's what financial accountants will do, because that is the rule. You're not paying tax on loss. But the strategic financial management, we also look at the impact. Now, the impact would be based on what the requirement of the question is. Now, when it comes to law, there are two things that can happen. We can have a situation where there is loss carried forward. So the question mentions that, oh, the company is allowed to carry forward any loss to redeem against future profit. So that is the first scenario. So, so the first scenario is that the question mentions, just like in taxation, mentions whether there's bilateral trade agreement or not, like we explained. But in this scenario, the question mentions that, one, there is loss carried forward. Two, the question mentions that there is no loss carried forward, or is silent. So if it's silent, we cannot assume that it's loss carried forward. So the question is silent on whether or not there is loss carried forward. So because it is silent, we cannot assume that there is loss carried forward. On whether or not there is loss carried forward. So I'm a little bit calm here because this is a new concept. So you're gonna see my speed is slower compared to when I was doing the other ones. Okay. So let's begin with the first scenario. Then we then go to our question and see whether or not there's loss carry forward or not. Now, when the question says there's loss carry forward, what it basically means is that we're going to offset the loss against future profit. So let's go back to our question and see, and let me explain that. So depending on the requirement of the question, okay, maybe I might say, okay, you can carry forward for 1 year, you can carry forward 2 years, or there's loss carry forward. So what that means is that going to our question, assuming the question said that there's loss carried forward, we are in this scenario going to use the loss to reduce any future profit down. So let's illustrate that, and then I'll clean it. So if you need to take a screenshot of that, please quickly take it up, and then I'll then clean it. So assuming the question says there's loss carried forward, all we'll just do would be say, okay, they said we can use our loss to offset future profit. So let's carry forward the loss to offset future profit. So we can put together and said, okay, loss carried forward. So we carry forward this to this because we have a profit here. Because we have a profit, I can take it there. So we carry forward that to that. So that would then mean that our taxable profit will be dash here. And here, what value would that be? 22.10 minus 8.24. What would that be? So that would be 13.86. So our tax will just be, the other ones will be the same. Nothing changes in the other one. The other ones will still remain 22.4 to 22.74. But that is how we treat loss carry forward. So we carry forward the loss and offset against future profit. If you need to make a screenshot of this, please do, because I'm going to clean it. So maybe you can do it, make a screenshot and maybe write it in your note or something somewhere so that you can remember how to treat the situation where the question says that is loss carried forward. Can I clean it?
Yes, sir.
Okay, so I want to believe you all have that concept. So I'm going to wipe it off. So that's the first scenario. I don't even know if the question says they loss carried forward, but we're going to come back. If there's loss carried forward, we're going to come back and rewrite it. I just want to use it to explain the concept. So we're going to go back and read that question and see if it's mentioned that there's loss carried forward or it is silent. If it's silent, we assume there is no loss carried forward. Okay. Now the question does not mention that there's loss carried forward, or the question says there is no loss carried forward. Now, unlike financial accountant, we're going to make a little change to our treatment. We're going to consider the impact of us making loss as against making profit. If we had made a profit of 8.24, not a loss, if we had made a profit of 8.24 and our tax is 35%, how much would we have paid as tax? Assume we had made a profit of 8.24, not loss. So 8.24 multiplied by 0.35. How much is that?
0.884.
2.88. Now the strategic financial manager looks at it and says, we need to take this into consideration in our presentation to management. And what we tell management is to say, because we made a loss, if we made a profit of 8.24 would have, of 8.24 would have paid 2.88. But because we made a loss, we are saving what would have paid if it was a profit. And so we are saving 2.88. So that becomes, instead of becoming a negative value, it becomes a positive value under our tax. Now that only applies to strategic financial management. In general finance, financial reporting, you will not charge tax on loss. However, because strategic financial management, we're trying to give management or portray to management fully the impact of decisions we make. We tell management, okay, because we're making a loss, it means that the 2.88 we will ordinarily have paid if it was a profit, is being saved, and that becomes a positive value. Any question? So let me just add that to my note on that, where the question is silent or the question said that there's no loss carried forward. So if there's no loss carried forward, the tax savings, the tax savings from not paying tax is reported. Because that is what we save. That is what we would have paid if it was a profit. Any question on our treatment of loss before we go to our question and see whether or not there's loss carried forward? We didn't have to do this in scenario A because we all had profit. Is there any question on how we will treat loss? Okay, so let's go to our question and see whether or not the question tells us that there's loss carried forward or not, or if it's silent. So if it tells us there's loss carried forward, we need to clean what we've just done now and go back to the first one we did. And if it tells us that there is no loss carried forward or it's silent, we just leave what we've just done, which is what we'll do if there is what do you call it? If there is a no loss carried forward. So let's get to our question. Where's my question? Okay. So this is the intro. This is because we read it last week. I need to scan. Because I don't want to read the question all over again, so I need to scan. So this is the other investment. This is the scenarios there. This is the sales and cost. These are operating cash flow. These are the expected probability of A or B happening. This is cost of capital. This is residual value, corporate tax, balancing charge, operating cash flow, exchange rate, project abandonment. Okay, so there's no loss carried forward. So because there's no loss carried forward, the question also mentioned that there's loss carried forward, we'll just go with the B, which would be that we consider the tax savings that would arise as a result of loss as against profit. The financial accountant would not do that because they would move on. But because we are strategic financial management, we let management know that, guys, come, because we're making a loss, we are saving 2.88, which we would ordinarily have paid if we had made a profit. Okay. So far your hand is up. Is it down? Okay, it's down now. All right. So let's go right back on to continue with our computation. So let's do our tax for the rest then. Those ones are pretty straightforward. For 35% of 22.10, what do we have? I need someone to help me with the computation.
7.74.
Okay, 7.74. 7.74. The next, sorry, so we don't make the same mistake we made before. That's a negative because we're paying it. The next one, 22.42.
7.885.
7.85.
7.85. 7.85. And then the next one.
7.96.
7.96.
7.96.
Thank you. All right, so that's taxation. So let's see if there's anything from scenario A that comes in here that applies to all of them. So we have done tax. So the tax savings on tax allowable depreciation is the same thing. The tax allowable depreciation value does not change. What changes was just the profit part of it. So we can just copy the exact same thing down. Oh, no. Where's our, did we account for the additional investment? Yeah, we did. Okay, we've done that part. So we're here. So our tax savings on tax allowable depreciation, 24.50. I'm copying that down because it doesn't change. Our investment is the same for both scenarios. So I'm copying down our 24.50. Let me mute yourself if you're not speaking to us. So our tax savings on tax allowable depreciation, we have that right in 24.50. 50. We have our balancing charge. Okay, so what's our balancing charge or tax? We basically copy the same thing for scenario A and scenario B. So I'm just copying it down. So that is 14.01. 14.01. So I'm just copying it down. It's the same thing for both scenarios. If it were different, we'd use the value for the new value. But because the only thing that changes is just the cost and revenue, every other thing remains the same. Okay, so this is the charge or tax. Our investment. Okay, so we bring that down from what we have from scenario A. It doesn't change. So we have our investment from scenario A at 70 and 40.03. Sorry, it's a little bit noisy. I need to mute some prompts. I need to mute everyone. Okay, 70. Okay, 70 and then 40.03. It was a little bit noisy, so I needed to just quickly mute those that are speaking. $70 and then 40.03. So I think that's about the only the other item again that we have that needed to go in. Yeah, that's all. These other items are the same. It doesn't change for scenario B. The only thing that changes was revenue and cost. So that's why we just copied down. We didn't need to stress ourselves. We didn't need to stress ourselves with the computation on that again. So this is 70 negative. So let's get the rest in. Oh, sorry. Why am I doing my cross sign under the 70? It should be on top. So 70 down. So let's bring in the other ones. Okay. So let's start with 2020. What do we have? Minus 8.24, 2.88, 24.15.
We have 19.14.
Okay. Thank you. So that's 19.14. Okay. The next one, please mute yourself. If your place a little bit noisy, if your side is noisy, please help me mute yourself. So the next one, 22.10 minus 7.74. What do we have? 14.36. Next one, 22.42 minus 7.85. 14.57. The next one, 22.74 minus 7.96 minus 14.01 plus 40.03. We have 40.8. Okay, so let's bring in our discount factor then. So we're just going to copy the exact same thing under scenario A because that does not change. So we're just going to copy the discount factor that we had under scenario A. So that the discount factor 0.870 So this is 1, 0.870. The next one, 0.756. 0.756. The next one, just a moment, why it's not moving? Okay. Okay, 0.75, okay, 0.658, 0.658, 0.658, and then finally 0.572. 0.572. Okay. So let's get our values down. So this guy is minus 70 for sure. So let's get on with the rest. 19.14 multiplied by 0.870, 16.65, 16.65. Someone can, if it's wrong, could please bring my attention to it. 14.36 multiplied by 0.756, 10.86, 14.57 multiplied by 0.658,
9.559,
and finally 40.8 multiplied by 0.572,
23.34.
0.34. Okay, so what do we have as our NPV then? Minus 70 plus 16.65, 10.86, 9.57, sorry, 9.59, 23.34. What do you guys have?
Minus 9.56.
0.56. Negative. Any question, guys? Any question on our scenario B? Okay, so let's go back to our question. We've done the values for scenario A and scenario B individually. So let's go right back to our question and see where we stop. So we've calculated the NPV for scenario A and scenario B. And then the second part of the question, it says, as well as the overall total expected NPV. So we explained the concept of expected value when we did local investment appraisal. I think our very first few classes, the concept of expected value. And when we said the concept of expected value, basically referred to multiplying the probability by the values and summing them up. So multiplying the probability by the individual values. And sum it up, our answer. So multiplying the probability by the individual values and summing it up gives us the expected value. So when we say overall total expected NPV, we're basically saying scenario A, what is the probability? So multiply the probability by what we have for scenario A. Scenario B, what is the NPV? What is the probability? We multiply the probability by the value, and then we sum up our answer. So let's see if we have the probability for the different scenarios. So that is the only thing we need to calculate our expected value. So let's see if we have that somewhere. We should have it somewhere. So it's right here.
Let us watch this video. So this is something I've never seen before. It's a mother, a daughter, impregnated by the same man. Repeat that nonsense. Repeat that nonsense. It's a mother, a daughter, impregnated by the same man. And
okay, so we have our probability is 70% for scenario A and 30% for scenario B. So let's see what the expected value would be. Just multiplying the individual values by the probability and then we sum it off. That's what the expected value is all about. So if you want to learn more about that concept, please go back to our original values on NPV, local investment appraisal, to learn more about the concept of expected value. But in summary, that's what we're going to do in this scenario. So our overall expected value. So our overall expected value. So all we need to do is to see, okay, what is the individual value? What is the probability? So we multiply them and that gives us the expected value for each option. We then sum it up to get our overall expected value. It's as easy as that. 3 marks. All right, so we have 2 scenarios. So if we had 3 scenarios, 4 scenarios, we'll just line them all up, or whatever we're calculating expected value for. So scenario A, scenario B. Our scenario B is a negative of 9.56. And scenario A, what did we have at scenario A? Positive 51.67. .67. So what's the probability? I think I remember 70%, 30%. But let me quickly confirm that I remembered correct. What's the probability for scenario A? What's the probability for scenario B? Yeah, scenario A is 70 and scenario B is 30. So I remembered right then. Okay. So 51.67 multiplied by 70%, what do we have?
Point
51.67 multiplied by 0.7 has a value of 6.7, 36.17, 9.56, that's a negative, multiplied by 0.3, still a negative, 2.87, 2.87 as a negative. Okay, so what's our overall expected value? 36.17 minus 2.87, 33.3. Any question on the overall expected value? Okay, so that's pretty straightforward. We just, what do you call it? We just multiply the values by the probability. That's what expected value is about. Okay, so let's get right back to our question. What's the next one? Okay, the next one says, calculate the payback period for the project for each of scenario A and scenario B. So we're going to do scenario A, and then I'll let you guys play around with scenario B so that we can round up, because we need to round up international investment appraisal today. So you just follow the same step. You just follow the same step for scenario B. So let's calculate the payback period then. So I'm doing the payback period for scenario A. So let you guys play around with scenario B payback period. Same steps, same approach. So let's begin with the payback period for scenario A. So when we say payback period, what do we basically refer to? When we say payback period, we're basically referring to the cost to recover our initial investment. The cost to recover our initial investment. So when we say initial investment, it's not just about the investment in the building, it's about the total amount you spend at the start to get the business up. That's what we mean by initial investment. It's not just a fixed asset, but everything you spend to ensure that you get the business up at the very start. So how much did we spend at the start to get our business up? And how long does it take for us to recover it based on the expected net inflow? Let's go back to our question and even begin to say, okay, what is our initial investment at the start? So this can be our fixed asset plus any expense at the start. Because when you invest money at the start of the business, it could be that you bought some assets. It could also be that you did some other startup expense. We need to be able to determine how do we recover this our startup investment. So let's go to our question and even see how much did we spend in total at the start. So we're going to compute our values in naira. Since our final answer is in naira. Okay. It mentions here, to date, 5 million has been spent on initial market research for the Nigerian market. So that's a sunk cost. That's not relevant for our decision. We're talking about what you need to incur to start up after that. If the project is approved, an additional 20 million will be required for detailed market research and packaging design, which was a relevant cost. The cost of the launch itself includes an expensive radio and television advertising campaign in Linda, and it is expected to cost about 70 million. Both of these costs are tax deductible in Linda. In addition, 84 million will be spent on the distribution center in Linda. All of these costs are payable on January 1st. So our key investment is 84 million Nigerian dollar. That's our key investment. Okay, so I think let's take off the investment because we categorize it under year one. So let's focus on our key investment. So our key investment is 84 million Nigerian dollar. And how much is that in naira equivalent from our computation? How much is that in naira equivalent?
70.
70. That's the only thing we had under year zero, which is our startup cost, 70. So under our year zero, in our computation, we had a startup of 70. So how long will it take us to recover this 70? You can present it however you choose to present it, but I generally like to present mine in the following format. So I would often have the year. So I would often have the year here. So if I had other expense that I had to place under year zero, I would have it added to the 70. But because of my computation, I had those other expenses because of tax in the year in which tax is paid. I just have 70. So I have my year here. I would have the description. I would have the amount. I would have the balance. Yeah. I'd have the balance there. So at the start of the project, which is year zero, we have our net cash flow. as 70 out. So balance 70. That's our net cash flow for that. In year one, what is our net cash flow? Not discounted cash flow. The question says payback period, so it doesn't tell discounted cash flow. So we're not going to use our discounted cash flow. We're going to use our net cash flow before any form of any form of discounting. So where's our net cash flow? Yeah, so here's our net cash flow. Where's scenario A? Are we in scenario A or scenario B? Yeah, this scenario A. So these are our net cash flow for scenario A before we discount. So at the end of year one, our net cash flow is 39.79. So that's what we got as our net value in scenario A. If the question says discounted cash flow, what's the calculate the payback period using the discounted cash flow, we would use this value. So please pay attention to the requirements of the value. If the question says what is the payback period using discounted cash flow, we would use these values because these are the values that are discounted. These are the values that we've applied the discount rate to. But the question doesn't mention that we should calculate the discounted payback period. So we'd use our regular cash flow before discounting, which is this one, which are these ones. I hope that's clear. All right, so let's go right into it. So in year one, at the end of the year one, we got 39.79. So we got an inflow 39.79. Let me double check that. Hope I didn't miss anything. Is that the correct value? Yeah, 39.79. So that therefore means that out of our 70 million, we have gotten 39.79 at the end of year one. So what do we have left to recover? What do we have left to recover?
30.29.
20.21. 30.21. Thank you, 30.21. That's what we have to recover. In year two, what's our inflow in year two?
35.55.
Where's our scenario A? Where's our scenario A? Okay, this is scenario B. Where's our scenario? Yeah, 35.55 is what we had in year two, 35.55. 35.55. We only need 30.21 out of 35.55 to recover our 70 million. So how long will it take us? How long will it take us to recover 30.21? We're going to just use a formula for that. When you have this kind of situation, it is the amount required divided by total inflow multiplied by 12 to know the period in months, because that total of 12 months makes a year. So how many months will it take us to recover 30.21? Based on that, it would be 30.21 from 35.55 multiplied by 12. So how many months? Rounded up, how many months?
10 months.
30.21 divided by 35.55 multiplied by 12. So it takes us approximately
10 months.
10 months. Okay, so what's our payback period then? It is 1 year.
Months. 1 year, 10 months.
10 months. 1 year, 10 months. Any question on our payback period? So with that, you should be able to do for scenario B. Any question? Okay. Now, like I mentioned, pay attention to whether or not the question asks you to use to calculate the discounted payback period. If it is a discounted payback period, you're going to use the discounted value. But the question just says compute the payback period. So we're using just our cash flow before payback. And also pay also complete attention to the fact that your initial investment would be what you have in year 0 or the beginning of the project. So if, for example, you had other expense at the start of the project, which you put under year 0, you're going to have it added to the 70 million. Okay. In our approach that we adopted in the question, what we did is, because tax is payable at the end of the year, we considered the additional 30 million expense to be under year 1, because tax is payable at the end of the year. Some other persons might do the same computation and say, oh no, let's consider it as year 0. And then just factor in the tax. If you choose to do that, it's an acceptable approach. The answer will still be roughly about the same thing, but that would change your payback value a little bit. You change your payback value a little bit. But I put it under year 0 because tax is payable, because I put it under year 0, under year 1, this additional expense under year 1, because the question specifically mentions that tax is payable at the end of the year. All right. So what next? We have a final part of our question, so we can round up, and then we can take general questions on investment appraisal. Okay, so we have done A, B. So we'll do C. We'll do B, and then we'll leave the C quiz part out as the theoretical part for when we do real options. Adetunji, your hand is up.
Thank you so much, sir.
Yep.
All right. My question is, you said that payback period. So if you have any other question, any other expenses, we added it together to give our normal year 0 cash flow. So I want to ask, what kind of expenses we look to be added? From the question where we get that 84, before we discount to 70, there are some expenses like those 30. They're also an expenses.
Yeah.
So I want to know. So how are you going to know the kind of expenses to add or type of fixed assets to add? Can you just help us to paint a scenario whereby that can be applicable?
Okay. So in this same question, if you take a different approach, those 30 million will be applicable. So what do you mean by that? The 70 million and the 30 million occurred at the start of the project, which is year 0. So ordinarily, if I wanted to take that approach, I would in my computation, this is what I would do. In my computation, this is what I would do. We would have, where's that computation? We would have this, our 30 million. We would have it come here, which is also acceptable. Because they all occurred at the same time. Which is also acceptable because they all occurred at the same time. So I would have this 30 million come here. So this would be 30, 70 as 100. It's acceptable. If you choose to do that, it's acceptable. However, I choose to place it under year 1 instead of year 0 because of this statement in the question. Because of this statement in the question. This point. Can you see this? Can you see this bullet point? Can you see the bullet point?
Yes.
Says operating cash flow, not investment, operating cash flow should be assumed to arise at the end of the year to which it relates. So my cash flows that those amounts that I incurred of 30 million is on January 1st. So at the end of the year will be end of January 2020. So that's the reason why I choose to put it under year 1. So if someone else decides to solve it and put it under year 0, assuming that, I want to treat it the same way I'm treating the 70 because they all occurred at the start of the project, ICAN will not frown at that. But if you do that, 2 things are going to happen. your answer is going to be roughly the same final answer. That's for sure. The only difference will just be that your what do you call it? Where do we come back here? Okay, where am I? Scenario A. All right. So the only difference will just be that this one. Sorry, this should be in bracket. Okay. So the only difference would be that this one, the loss will increase by 30, and this will be 53. So it's more like the 30, just a swap shot. So this would be 100, and this will increase because they're no longer subtracting 30 here. This will increase. So this will be like, this will be your 53.53. This will be 100. So by the time you net it off, 53.53 minus 53.53 plus 100 will still take you back to the net total at the end of the day. I don't know if that's clear. If you understand what I'm trying to say. Do you get that?
Yes, sir. Yes, sir.
Yeah. So that's just the only difference. So some people might decide when they are solving the quiz, so they might decide to say, oh, let me treat it the way I'm treating. Let me treat it the way I'm treating the investment because they're all occurring at the same time. Some other person might say, but this statement says, let me treat it as an operating cash flow because for tax purpose, tax is going to be paid. So if you do an expense at the beginning of the year 2020, tax will be paid at the end of the year. So because of the fact that tax will be paid at the end of the year, let me put it under year, or what do you call it, under year 1. Now, if you do that, if you put it under year 0, your answers will be largely the same. If you put it under year 1, your answers too will be largely the same. Why do we say so? Because when you come to your payback period computation, where's payback period computation? Where's my payback? Yep. So this will increase because you didn't subtract 30. So this will be plus 30. This will be minus 30. So it will net off. This will be plus 30 because you will not have subtracted 30 on that one. So this will be plus 30. This will be minus 30. So at the end of the day, it will net off. Hope that's clear. Hope that's clear.
I didn't get that.
Okay. So if you had placed your, what do you call it, your 30, those 30 expense under year 0, right?
Yeah.
So this would be plus another 30 minus because it's an expense now. So this would be 100. This, so because you didn't subtract it here, this would be 39.79 plus 30. That would be what? 69.79. So 100 minus 69.79, what do you have?
50.21.
Okay, so 30.21. 30.21. So can you see the value? Can you see the balance?
Can you
see the balance? Can you see the balance?
Yes, sir.
So you get largely the same thing. So it all depends on the approach you choose to adopt based on how you interpret that particular statement. Hope that's clear.
Yes, sir. So in a case whereby in that beginning of that question or in the scenario, we're not giving that maybe the business they buy additional assets. That means you want to add it back to that year 0 2 as well, right?
Yeah, if it's at the beginning of the year. Yeah.
Thank you,
okay, sir. Yeah. So the only reason why I played the 30 point, like just to summarize that, the only reason why I played the 30 point, I choose to place it under year 1 is because of that statement I mentioned that operating cash flow occurs at the end of the year and tax would definitely be paid at the end of the year. But if I had chosen otherwise, we will still arrive at the same final answer. Okay. So let's get right back to a final part of our question quickly. So what's the final part of the question? Our computation part of our question quickly. Okay, where's that? All right. Evaluate whether or not the project should be abandoned on January 1 if scenario B occurs. Now let's pay attention. So I want to teach you guys ability to think through a question, which is very important because oftentimes what I notice students do is that they don't think through the question to really understand it. So the B scenario is saying that should we abandon the project on January 1? if based on scenario B. Now, based on scenario B, should we abandon the project on January 1, 2021? No, so guys, this is our scenario B computation. And this is our scenario B computation. Now, if we abandon the project on January 1, will we enjoy this benefit? Will we be able to make 27.59 at the end of the year, 28.55, or 81.54? Would we be able to make those values if we abandon the project on January 1? Would we?
No.
Sorry, I didn't get that. No, we will
No,
not.
sir.
So we will not. So instead of doing that, we will just sell our project. We will just sell our investment and do what? And move on if we abandon it. Okay, Lola, your hand is up. Go ahead.
Yes, sir. Sorry, sir. I don't understand how you get the payback period to be 1 year, 10 months. Because when I calculated it, I got 10 point something, which would have
so that's the
10 months.
Yeah.
So the 1 year, how did you come about the 1 year?
Yes. Yeah. So our first inflow, we took that in now. So that's the year 1. This is our year. Our first inflow, we were able to factor that in, leaving us with a balance of 20. So we have our first inflow our first year's inflow fully accounted for. Okay. So this is the year 1. Did you see that? So that is the year 1.
Okay, noted. Thanks.
Yeah, right. Okay. Yeah. So back to our question. So if we choose to abandon the project, we will not enjoy those cash flow. So we need to calculate, we need to determine is it best for us to, 1, abandon and lose the cash flow. So if we abandon, definitely we will sell the asset. So we need to determine how much are we going to sell the asset versus do we continue and enjoy or receive, not really, and receive the 2021 to end benefit. That's what the question is about. We're going to go for the option that is better. So we're going to go for the option that is better. That's what we will do. We'll go for the option that is better for us. So let's now determine if we choose to abandon the project and we decide to sell the asset immediately, what are we going to get? Let's go to our question and see what we're going to get. We choose to abandon, what are we going to get? We can sell the asset for 70 million Nigerian dollar. We can sell it for 70 million Nigerian dollar. So let's now do our computation. Now that we understand the question, do we collect our 70 million in 2021 and move on, or do we continue and enjoy those other benefits, those cash flow from 2021 down to the end? So let's go on with our first option, which is to abandon. So if we abandon, we're going to have our distribution center sale. And then we're going to pay tax. Because we already were, what do you call it? on the own, whatever we get, which is our balancing charge. Okay, so we're computing our value in Naira, and that is 70 million Nigerian dollars. So we need to convert it to Naira. So we're selling the distribution center on January 1. So 01/2021. So what's the value for us? What's the Naira equivalent? Well, what's our exchange rate? Okay, so our exchange rate, now pay attention to this, and I mentioned it before in terms of timing of a cash flow. Our exchange rate at the end of 2021 is 1.2485. That is our exchange rate at the end of 2021. However, we are selling the equipment when? When are we selling the equipment? When are we selling it? Is it at the end of 2021? When are we selling the equipment? When do we want to abandon? So we know if that will be
at the beginning of 2021. At the beginning.
We want to abandon at the beginning of 2021. Now, if you're an accountant, you know that your closing balance is your opening balance the next day. Your closing balance is your opening balance the next day. So if in our question, it tells us that the exchange rate at the end of 2021 is 1.2485, the closing balance at the end of 2020 is 1.224. So what do you think is the exchange rate on January 1, 2021? Your closing balance at the end of the year is what? Your closing balance at the end of the year is what?
1.224.
Yes, but let's get the point. Your closing balance at the end of the year is what? Your opening balance the very next day. Your closing balance at the end of 2020 is your opening balance on January 1, 2021. So the applicable exchange rate we would use would be 1.224. However, if that abandonment is occurring at the end of the year, what exchange rate will we use?
1.12485.
Yes.
1.2485.
Yes.
Thank you. So please pay attention to timing. Very important. And the date as well. So what is the Naira equivalent of our 70 million? So 70 million divided by 1.224. Sorry, where's my computation?
57.19.
Okay, so we can call that, yeah, so we can call this here 0 because it's a new investment appraisal we're considering whether or not to abandon. We can call this here 0. So that is your 70 divided by 1.224, which is 57.19. Any question on that value, please? Any question on that value, please? Okay, we need to pay tax. When are we going to pay tax? We're not going to pay tax on January 1. When are we going to pay tax?
At the end of the year.
Let's go back to our question. Let's go back to our question. Question says that tax, it says corporate income tax is charged in Nigeria at 35% on taxable profit and is paid at the end of the year in which the taxable profit arises, meaning that it's going to be paid at the end of 2021. It's going to be paid at the end of the year. So at the end of our year 1, under that appraisal, at the end of 2021, so what's our tax now? 35% is the tax rate. So can we calculate what the tax is then? 57.19 multiplied by 0.35, which is our tax. What do we have?
20.
Okay, so I'm using 2 decimal places. So is there any decimal place to it?
20.01.
02.
02. So it's a tax, so that's a negative. Okay, so we're good. So let's discount now. Okay, so anything that's about 0 is 1. So what's our discount factor 15% year 1? We've calculated it before, so let's just copy it down. Here, under year 1, 0.870 is our year 1 discount factor. But it's a new investment proposal we're looking at, 0.870. Okay, so what's our present value? And what's our NPV if we choose to abandon? Okay, so that multiplied by this gives us 57.19, and then we pay tax, the discount factor
17.41.
42, please. So what's our NPV if we abandon? 39.77.
39.77.
So if we abandon, we get a net present value of 39.7. So what if we don't abandon? If we don't abandon, we will continue to enjoy all those projections that we had before now, all of those projected inflow. So if not sold or abandoned. Okay, so if not sold or abandoned, what will we get? Let's go to our scenario B because that's what we're focused on. So if not sold or abandoned, we will enjoy all the benefits. And the benefits are, sorry, where's my scenario B? Oh, sorry, that's up. I should be looking at down, which is the net cash flow. That's before we remitted. So this is our down. This is the final net cash flow. The other one was at the subsidiary end. We're interested in the final value for us. So we would enjoy the 2021, 2022, and 2023 if not abandoned. So that's what are the values? 14.36, 14.57, and 40.8. And we copy those values down. Those are our year 1 to 3. So this is a new investment, a new decision. So if we abandon our year 1, we would have what will we get? What will we get? Because we're not abandoning, we'll continue to produce and continue to make our money. 14.36. So this is 14.36.
14.57.
14.57.
And 40.8.
14.57. 14.57. 40.8. So we'll continue to enjoy all of those cash inflow because we didn't abandon. But now we must discount. Strategic financial managers, we must always discount. We must always find the time value of money. So let's discount. So the question says we should use scenario B. So we're using scenario B. So pay attention to the requirement of the question. If we were to use scenario A, we would have used scenario A. So let's discount. Our year 1 is already up there. Discount factor is 0.870. So let's look at our copy other years from our computation before. So based on what was in that, so sorry, this is
756.
0.756 and 0.6 and 658 and 0.658. Yeah. So for this particular proposal, our 2021 is our year 1. That's why we're using the year 1 discount factor. So that's 0.870, 0.756, and 0.658. Okay, so let's see what makes sense for us. So let's multiply that. And that, okay. 14.36 multiplied by 14.36 multiplied by 0.870.
12.4. 12.49. Okay,
12.49. I'm using 2 decimal places, so let's be consistent.
Yeah.
14.57 multiplied by 0.756. 11.01.
11. Okay, yes.
Then finally 40.8 multiplied by 0.658. 26.85. Okay, so what do we do? Do we abandon or do we just continue with what we're doing? Continue with our investment? Let's sum it up.
We should continue.
12.49 plus 11.01 plus
50.35. 50.35.
Okay, 50, so someone says they have
50.35.
50.35. So guys, what do? Do we abandon and collect our 39.77 or do we continue? What should we do?
We continue.
Continue. So a decision, the project should not be abandoned. The project should not be abandoned, as it is more profitable to continue. Any question, guys? Any question? Okay, so that's been our consideration of international investment appraisal. I've tried to ensure that I touch, even when it didn't involve this particular question, I've tried as much as possible to touch on the concepts and how to treat them. So tax, laws, and everything. So what I expect you guys to do is take your time and rewatch the video again, if you have to, from the beginning to the end. And then the next step for you after that will be to look for other past questions on international investment appraisal. So you can look for maybe one or two more. If you can solve those one or two more comfortably, then you can tick international investment appraisal off your list that you are fully okay with this particular topic. Okay, so that's our session for today. If there are no further questions, thank you so much, guys, and see you in our next class. Thank you.
Thank you very much, Mr. Wim. We are grateful.
You're welcome. Welcome.
Thank you, sir.
Thank you, sir.
You're welcome.
Thank you very
Thank
much.
you, sir.